What's up, man? I want to cover a couple of possible positions that I saw yesterday. Even though we had a high resistance liquidity run day, I still watched the day and I still tape rate the day. So we opened the day up and I specifically said that I wanted to see price move back up into this weekly fair value gap, which in Q we did. Traded back into that. So my expectation was to see prices trade higher for the day. Let's go backtrack here. So I noted this 4-hour in fair value gap, and below us we had this daily inversion. I believe we also had I had a 15-minute fair value gap noted. I believe it was down here that I had this noted. I believe I had that noted down there, which technically this is an inversion. So inversion, 15-minute inversion. So this daily would be a reclaimed, since we traded through it and we came back above it. So that technically this is a reclaimed inversion. So there's that. So I was looking for bullishness initially. We had at 8:30 we just had core retail sales, so nothing major to worry about, since it also was a Monday, so didn't expect much. So super messy out of the gate. Super messy, but we did trade into this. Forget about this. Just ignore this for a second. We had this daily inversion and we were sitting inside of that. And then 15-minute fair value gap. There's that 15-minute fair value gap. Wait, hold on. Give me a second. 15. Oh yeah, right there. This is right. Yeah, right there. I saw that gap. I did note that gap. So let me go ahead and get that into frame. Got a whole bunch of stuff going on here, but we're just gonna have to bear with me here. Bear with me as we go through this information. So 4-hour fair value gap. This was the 4-hour fair value gap. I took note of that. That was the first draw before we got into this weekly. Of course, we have these highs. So that was a draw on liquidity that I wanted to see. So first things first, 8:30, we had this little move. We traded down and then up. Now look to your left and you see low, high, lower, low. So that's like apparent It classifies as a breaker block, low high, lower low, breaker block. Pull that through. You also have low high, lower low. You got a breaker block sitting here, and it did not get traded back into. Price traded back into the higher one. So the higher breaker block got traded into twice. See, we broke above it. Traded back into it, 832. Traded back down into that one last time, 833. So framing this setup, look at the break block. And in this case, the stop, I just placed the stop below these breaker blocks. You also have a inversion right there. So just below that, that's good enough. Good enough. And 12% targeted. So there's that one position panning out. 12% would then be hit off of that. So after the fact, price rallied up, tapped into this 4-hour fair value gap. We then stalled. We stalled right there, and I didn't like to see this around approaching the 9 o'clock hour. I didn't like to see this. To me, this was okay. We're stalling. We're falling back into this massive drop which we had. So to me, that was a immediate sign of slop. We got slop. So price traded down lower. Traded lower into these 15 reaching back down into that daily inversion. Just extended that out anyways. We did come back into this lower later on. So we trade back into this top of this daily reclaimed inversion. Massive rally away into this 4-hour fair value gap. So this gives a beautiful base for a short position. So this short would be trading against the higher time frame because we are looking for long ideas. So this would be a scalp trading against, so which means something that you would take with a lower risk. So breaker block, simple to see, low, just barely fell short of this consequent encroachment of this 4-hour fair value gap. Tanked, beautiful impulse move below that, come back into the breaker block. We have coupled with the breaker block, an order block sitting right here. And we have a fair value gap spanning these down close candles. So that would be the high. And the low would be here. And you also have a fair value gap here or a fair value gap there, if you wanted to look at it that way, depending on how you look at that. So you got those levels. And time of day would be 9:50. So that's a beautiful little macro that you could expect something to be traded into. Stop was above the breaker block. That's what would be tolerated as per my model. You could place per se the stop above the order block if you wanted to do so, if your model tolerates, or above the high, depending on what your model tolerates. My model tolerates this, so this is what I took note of for my journal. So anyway, 9:54, that would be the entry. Traded the high of this into that order block, pulled in, sitting inside that fair value gap, and we fell out of bed did sit through some consolidation. We did get a rally lower, and this is a potential move for 10 handles, since you would be targeting this low and trading back into this fair value gap, overlapping with it. So this would be a 10 handle or a 43 point move lower. As per usual, I note this as 12% or 23 points. That's how I note it. That's how I journal it. So there's that move. Since we traded into that 4-hour, we could expect a reasonable retracement lower. Price came back into this same breaker block area. Again, personally, I don't like to see price come back into a level like this and execute on that. I've found that more times than not, for me, if price comes back into a level like this, then it's either going to trade through the level, or if not through the level, then it's an indication that we could be sitting in between higher time frame PD arrays like we are here, and we're going to get a Z day. So this could be a potential short. This could be a potential short off of the same breaker block, fair value gap, order block. Even these up close candles here would be an order block. Really depends on what you see. If that's part of your model, then you should journal that. That's what I saw. That's what I journaled. So again, let's move this over. Trade it down back into that daily reclaimed inversion. And we subsequently had a low, high, lower low, traded through that very impulsively. Time of day is 10:38. So that would be 10:20 to 10:40. Traded back into that here. 10:42. Move it over a little bit. 10:42. As you can see, tapped it in. Stop would be, we have this up close candle, breaker block, order block, fair value gap. Stop was at the fair value gap, sitting right about main threshold of the order block. So I feel like that's a nice area to place that. Really nice stop. 5 handles were targeted. As you can see, I talked about sometimes you're going to get these breaker blocks, especially if it's a Z day or if it's a super messy setup in general, then you might be lucky to get 5 handles out of it, or 25 points, or 12%, 13%. You might just get the 5 handles. You're not going to get the 10 handles out of it. Okay, 10 handles will be missed. So that's for your notes. 5 handles will be traded, but not 10. So moving it along. Extend this out because we did trade back into this as well. So the fact that we traded back into that 4-hour fair value gap, we rallied away, daily inversion. I think I had a $15-minute order block. Oh yeah, the 15-minute order block came in right there actually, which was something that I had noted. I thought that I had something else noted here, but it appears not. It appears not. But we had this 4-hour base. Traded away from that. It wants to continue going lower below these lows, those lows. Another move I saw was price trading higher, making a failure swing here as far as the candle bodies. Failure swing. But if you look at this and you look at the wicks, you see that we wicked past these bodies. Your breaker block is going to be a high, low, higher high. Trade through this structure, which it did. Trade back into it. Now, if you look at this a different way, if you look at high, low, if you look at this structure and if you ignore this wick and you get high, low, and the bodies come pretty close to it. Let's say high, low, higher, high. Then this could be used as a mitigation block. So price traded back into that mitigation block, line up with a fair value gap. Trading with the bodies inside the breaker block. That's a potential entry to go short with the stop tolerated. My stop tolerates up to here, 9%. Can't place it above the high. It's too much for my model. So 9%, place it there. Take profit 12%. This one, you could have gone for the 22%, 42 points. Could have gone that, would have hit your target, traded below this low. As a general, I place it at 12%. So that's another example that could have been taken. This was taken in the 1050, 11:10 macro. So really nice time of day that you expect something to happen here. We had failure swings on US, and I believe we had the same thing. Yeah. We had the same phenomenon on US 500. US 30. Let me see. Yeah, we had the same phenomenon, just a failure swing. Just a failure swing, just failed to get trade back above this, showing weakness. 1050. Just looking over ES. And I want to take another peek at 1050. Yeah, US 30 was weak too. So this here is a mitigation block. Use it as a mitigation block. Since we had a failure swing, high, low, lower high, traded through. Price did tap into that mitigation block right there, but the body stayed in the breaker block. So that's an indication that it's showing weakness. So it's a confirmation you can use on the trade. That's a beautiful little setup. If you executed that, another 5 handles. So that's pretty much what I was watching while I was tape reading this price action yesterday. We ended up trading back down into this 15 inversion. Yeah, that's about it. And then we rallied higher up into PM. So if you look at a 15, you look at this price action, then yes, it's messy. It's not Monday. Look at this Monday. This was it, folks. This was it. Straight up and all the way back down and then up. Super messy day. Nonetheless, like ICT tweeted that these are the best learning environments, honestly, because it's not always about when do I get in? When am I supposed to get in? When's the best times to get in? You should also know when to stay out, when not to get in. When should you be watching from the sidelines or studying it? How do you anticipate difficult conditions? Well, the honest answer is you gotta go and you have to sit there and you gotta study. You need to go through a calendar year and you need to study. You need to tape read, journal, study. You gotta get the experience. That's the only way. That's the only way that you're gonna know when to anticipate high resistance. This is a FOMC week. So you don't expect much from Monday. You're not expecting much from Tuesday. You don't even touch it Wednesday morning. You can look at getting in at Wednesday PM after FOMC release. You can look for opportunities to get in. And you got Thursday and Friday. Monday and Tuesday is you expect them to be wildcard days. They're either going to be consolidation, messy, or you're going to see crazy volatility stepping in, like ICT said. Same thing today. So far, it seems choppy consolidation day, or you're going to get massive volatility stepping in. So far, we can see that nothing much has happened here. We're sitting in yesterday's range. There, you can see we traded up, down. Not much has happened here. Okay, this is what has happened. Not much. So it's important to study the days when you should be staying out of this, when you should not be touching this, because that's going to give you an edge by itself. Not trying to force trades every single day, trying to get in there every single day, but knowing which days can I anticipate price to be messy or wildcard days. And you can just avoid those days altogether and get in there when price has a better probability to be a low resistance liquidity run condition. Yes, you will move, you will miss good moves in doing so, but I can guarantee you that more times than not, you're going to filter out days that you probably would have taken a loss. And that in itself gives you a higher probability win rate. And this is the stuff that people don't want to hear, and they don't want to sit and listen to this stuff because it's not the nitty gritty, get into it stuff. But honestly, this is what you need to hear, because this stuff is the type of things that end up making you profitable. Because let's say, as a stupid example, if you're a break-even trader and you journal and you look at the journal and you see, okay, but looking at my journal, I can see that I took a trade on, well, let's say in the example, it's let's say it's an NFP NFP week. And let's say, okay, you took a trade on, you had a beautiful winner on Monday, you had a beautiful winner on Tuesday, but Wednesday morning you came in, you took a trade, and that was a loss. Thursday you came in, you took a trade Thursday morning, that was a loss. Okay, so now you're back at even. Friday you didn't take a trade because that's NFP, so you just don't trade that. So if you go back and you look at that stuff and you say, okay, but the rules say that Monday and Tuesday is trading days on an NFP week. Okay, if the conditions are optimal, if price action is not a mess, then those are trading days. Wednesday and Thursday should be days that you stay out of the marketplace. So if that trader stuck by that system and he only took a trade on Monday and Tuesday, but he didn't look at it Wednesday and Thursday, he just did something else, and he took two winning positions. He took a position Monday, took a position Tuesday, and those trades were winners. If he closed it for that week after Tuesday, then he would close that week off with a profit instead of closing the week off with an even. And this is where it starts adding up, because every single week you're going to have different types of news events. You might have a CPI. You might have a CPI Wednesday and a PPI Thursday. So if the trader comes in Monday and Tuesday, he trades, takes a loss, Monday takes a loss, Tuesday, Wednesday after CPI, he takes a trade, and that's a winner. And Thursday, he takes a trade right after PPI, that's a winner. If only he filtered out Monday and Tuesday and waited for CPI to be released on Wednesday, looked to trade Wednesday and Thursday, and didn't take the two losers on Monday and Tuesday when price action is expected to be choppy and messy, then he would only have traded Wednesday and Thursday. And if Wednesday and Thursday were both winning days for that trader, then he would close the second week off of a profit. So it's small, stupid things like that that keep you from profitability. Nobody wants to hear this stuff. Everybody wants to know how to get into the trade, what time to take the trade, where to place the stop, how to manage the trade. But people don't understand that you need to filter out low risk days, and those are the days that you should be sitting and you should be studying price and tape reading it. And then you start understanding why you don't want to be sitting inside those conditions, because you spend so much mental capital sitting in trades like those, which are completely unnecessary. You can save all that mental capital and come in when the conditions are ripe for movement, and it's sell days. You get in and price rallies to TP. Price moves away from the entry, gives you immediate response. It's quick. Bam, bam. Take profit. Done deal. Instead of being up and down, making a gap, filling the gap in, sitting sideways for 3 minutes, rallying back down, then moving back up, filling the gap in, rallying down a little bit. So instead of spending mental capital, you wait for the conditions to be ripe for price to move. And you sit on the sidelines and you save your mental capital during the days that price is poised to have high resistance liquidity around conditions. And you study those conditions And that's how you learn that, okay, these are the days that I want to sit on the sidelines because I'm going to burn my hands. But nobody wants to hear that. Nobody wants to hear that. Hopefully, this one was insightful. Hopefully, you have something that you added to your journal. And until we speak again, good luck.